Hello everyone, welcome to this new weekly chapter. This is chapter 17 and it's going to be specifically about time. In this chapter, we will discuss what time is, what is its importance in our analysis and execution, and how we can use time to be more accurate and precise in our analysis, and moreover, how we can use it to filter out lower probability conditions. We will also discuss what are the different concepts that can be used to time the markets and build much more cleaner narratives. Now, till now, you've heard everyone talk about how important time is, right? And how it's important than price, and how you should be using it in your analysis, but they never tell you how it's done or what does it mean to use time in our analysis, right? But in this video, I'll make sure to clear almost all of your confusions and doubts about time. And at the end of the video, you'll be fully equipped with enough knowledge to use time accurately in your analysis and use it logically with a sound logical framework. That's going to be my objective with this chapter. So let's start the chapter. Now, first of all, let's introduce what time is and what does it actually mean. So, we all know that ICT or CRT based trading relies on two main and major integral components, right? Which are time and price. And and that is what makes up the charts as well, right? Now, about price, we know that the market perpetuates itself in the form of liquidity when it comes to the price aspects of the chart. Market first accumulate or generate liquidity, it then manipulates or purges that liquidity, and finally it neutralizes or distributes that liquidity in the form of expansions. This is how price perpetuates itself on the charts, right? All these ICT and CRT concepts revolve around the relationship between price and time, right? And these concepts, we make sure that we accurately combine time and price with each other in a sound logical framework, and that eventually leads us to having a really high margin of accuracy. If time and price aren't aligned with each other, then you wouldn't be able to accurately catch expansions and reversals in the market, right? But when they're properly aligned with each other, you will have a great deal of accuracy to know where the market or price is headed to and how you can exploit it by positioning yourself. So, to achieve a great accuracy and precision in both your analysis and execution, right, you must be fully equipped and well versed in both aspects, right? And not only that, but you also must know how to integrate both of them with each other logically. And CRT and ICT analysis, we often consider time is more important than price, and you'll see that why in a minute. Now, let's talk about time and price theory. You know that till now in CPI we talked about multiple and various concepts, right? Many of those concepts were related to the price aspect and many of them were related to the time aspect, right? In this part of the chapter, I'll show you which concepts are predominantly time related and which ones are predominantly price related, right? And then we'll discuss how to use each one of them respectively and their respective aspect. On the left you can see that we've got the price aspect of the charts, right? And below you can see all of the concepts that are predominantly based on price, and that helps you analyze the price aspect of the charts, right? First one we've got is market profiles, right? We've already talked about it before multiple times in our trading breakdowns, and we also made two separate chapters on it, right? And we know that the market moves in profiles, and it always moves from one profile to another profile from time to time and moves price while using liquidity to position itself. Now, examples of market profiles are ranging profile, manipulation profile, expansion, retracement, and reversal profile. We've already talked about the different combinations of these profiles and their respective outcomes in chapter 1 and 2. And if you haven't watched those chapters, make sure to watch them first. Those chapters will clear almost all of your confusions about how market moves and profiles, right? Now, the second concept that is predominantly based around price is key levels, right? Now, I've also made a separate chapter on this one too, right? So basically, each and every key level has specific qualities and characteristics due to which it's considered a valid key level, right? And then each one has its own intricacies in terms of price action and how it's used as a catalyst to generate explosive moves in the markets, right? Key levels are the main catalyst used for expansions and reversals, right? And in chapter 2, we've discussed how to combine key levels with market profiles. And if you haven't watched that one, make sure to watch that chapter, and that one will clear all of your confusion about integration of key levels and market profiles. Next one is dealing ranges or PDRA metrics, right? We've discussed this one as well, and basically what it does is that it divides an expansion swing or a range into two halves with discount and premium region, and then each having its own respective key levels, right? With different characteristics, right? We've also discussed the integration of dealing ranges with the other concepts and the separate in a sap in a what the fuck in a separate chapter in CPI. Then next up we've got a CRT, right, which is the main concept we use to determine drawn liquidity and build a narrative, right? It is also a price concept inherently, but remember, CRT won't work alone and you must use them with the time concepts and the other price concepts to make it work accurately and to gain a greater precision in your analysis, right? Then we've got turtle soup, SMT divergences, power of three, and last but not least, market maker models, right? These are all the concepts that are price based, right? That are predominantly price based. But remember, it doesn't mean that you can use them alone, but instead, they all must be integrated with each other accordingly in a sound logical fashion around a logical framework. And moreover, they're all dependent on each other, right? So remember that. Next main important point is that time, right? Time is also an integral part of all these concepts, right? And in order for them to work accurately, you must use these time concepts and integrate with them, right? And only then you'll be able to see the magic of time and price. And that is what ICT and CRT analysis are about, right? Time, price, CRT, and logic. Now let's discuss the time concepts and see what each one of them represents. So the first and the foremost main important concept when it comes to times is kill zones, right? Kill zones are specific and key times of the day, each having their own characteristic, right? With the help of kill zones, you will be able to profile the intraday you'll be able to profile the intraday daily range, and you'll be able to see and filter out high probability conditions and low probability conditions, and most importantly you'll be able to time the markets accurately, right? We will discuss skill zone in detail in a minute, but first let's discuss the other ones briefly. Next one we've got is quarterly shifts, right? Now this is an important time topic, right? And it's almost completely based on time, right? I made a chapter on it last week, discussing every single intricacy of it. So if you haven't watched that one, make sure to watch that chapter too, and you'll understand how is it based on time and how you can use it to catch timely shifts, expansions, and profiles in the market at specific times of the year. Next one is seasonal tendencies, right? I'm sure you've already watched the chapter on seasonal tendencies, and you'd understand how to combine it with other concepts like market profiles, key levels, SMT divergences to generate higher time frame trading ideas and analysis and build higher time frame narratives, right? Seasonal tendencies are also best when combined with quarterly shifts, and with both of them integrated accurately, you can really attain a good accuracy, right? Next up, we've got is day of the week, right? Now, the two concepts above quarterly shifts and seasonal tendency that we discuss, they basically helps us in identifying expansions in the yearly range or on a monthly basis, right? Meaning you could find high probability expanding months with those concepts together, right? And now with the day of the week, we're finding high probability days instead of months, right? And we'll discuss that in a minute how, right? And next up is the time of the day, which is basically kill zones and key macros or key times during the day, which could be matched with other concepts and can lead you to have a good margin of accuracy. Then we've got another time related concept, which is the open high low close concept or the open low high close concept. And you might have already seen the chapter on it in CPI, about how does it work and how you get integrated with the other concepts, right? So if you haven't seen it, then watch that chapter first, right? And then we've got time frame selection and time frame alignment, right? And which basically we learn how to align different time frames with each other in a logical manner, and how to choose the correct time frames to align them with these concepts properly and correctly. And then last but not least, we've got weekly profiles and intraday profiles, right? And with these advanced profiles, we can divide the weekly and the daily range into different halves in terms of time. And then each one of them has their own characteristics depending upon the type of key levels we've got, the position that we are in inside the dealing ranges, and so on. I've like made chapters on all of these concepts and topics in CPI, and you should make sure to watch all of them first and then move on to these next chapters, right? Because those chapters will teach you how to use each concept separately, and it will also briefly discuss how to integrate it with the other ones in a proper sound logical framework, right? And with these new chapters, I'll teach you about time, and then the rest of the chapters will be all about integration of these concepts, how to do higher time frame analysis, intermediate time frame analysis, lower time frame analysis, what are entry models, what are the different types of entry models, how you can integrate your entry model with your higher time frame analysis, how to determine drawn liquidity, both the short-term drawn liquidity, long-term drawn liquidity, how to build narrative on the higher time frames, how to build narrative on the lower time frames, how to properly journal, and how to execute with optimal performance, right? And much more. All of these things will I will make sure to discuss them in CPI. So we are in for a lot of fun, right? So with that being said, you can see that the main part of CPI starts now, right? Knowing all about those concepts is great, but the most important part is knowing how to integrate them all of with each other, right? And the most important part, which is how to integrate it with time, and how to use it to generate trading ideas, determine drawn liquidity, build narrative and bias, right? How to use entry models, and like as I said earlier, how to integrate them with the narrative in the higher time frame drawn liquidity, and so on, right? All of those stuff will be discussed in this second half of CPI, right? Now let's move on and let's talk about the importance of time. So first of all, most of us know that the most significant in expansions and major expansion happens at key times of the year, key times of the week, and key times of the day, right? By understanding the time aspect of the charts accurately, you will be able to identify and differentiate between low probability conditions and high probability favorable conditions, right? And that understanding will then further lead you to catch explosive and significant moves and expansions with a great deal of accuracy, right? And with a good understanding of time, you'll be able to build sharper and cleaner narratives. The most important aspect and part of time is that it confirms, listen to this, it confirms the validity of all these price concepts like SMT divergences, key levels, weekly and intraday profiles, turtle soup, CRT, or its barges, right? All of the price concepts that we discussed so far in CPI, right? Right? For the validation of all those concepts, time is used, right? If the time is aligned correctly, right? And if the time is aligned correctly and it's right, then we can confirm that those concepts are valid and we can use them to generate trading ideas. But if the time isn't aligned, then we would avoid it and it wouldn't be confirmed as a valid, right? As a valid idea. That is what time is predominantly used for. Time serves as a major confluence for generating trading ideas. And last but not least, time acts as a powerful filter, right? It's one of the best filter which can help you set out low probability conditions and only participate and take part in high probability, quality and favorable conditions. Now let's look at some graphics and see how does time confirm the validity of certain concepts. So moving on to the next slide. Right here in this graphic, first of all, we've got a key level, right? And then we've got the two different types of reactions that price had towards this key level. We will discuss why both reactions are different from each other and what led to the difference in the reaction to the respective key levels, right? First of all, let's discuss the reactions on the right. On the right side, you can see that we've got this green rectangle in the bottom, right? And this basically represent a key time depending upon its time frame, right? Let's say if we are looking at a 15-minute time frame right now, then that would mean that this green area represents either the London Open Kill Zone or New York Open Kill Zone or any other key time of the day. If we are looking at it on the 5 minute or the 1 minute time frame right now, then that green area would represent a key macro or a key time such as the 3 a.m. macro, the 8 a.m. key time, or such as 11 a.m. key time, right? If this price action is on the 4 hour time frame, then that area or that green rectangle will represent a key time of the week such as Tuesday or Wednesday, right? Now the point I'm trying to make is that depending upon the time frame that you are looking at it, right, each one of it is going to have their own respective key time, right? And you must be able to differentiate between them. And the second point is that these reactions I have shown are fractal, right? Meaning you will be able to find them on all time frames depending upon time frame alignment, right? So I wanted to make sure that you aren't limited in your thinking that it only happens on the 15 minute or the 4 hour or whatever, right? It happens on every single time frame. Let's say if you are looking at it on a monthly chart, then that green area would represent a seasonal bullish tendency, right? So it all depends upon the time frame that you are looking, right? And then based on the time frame, then you can decide whether you want to choose a seasonal tendency, where you want to choose a kill zone or whatever, right? Now let's get back to the topic, right? So let's say this green area represent a key time on its respective time frame, right? And what you can see right here is that price came down below to test this key level and turtle soup below this low inside a key time or at a key time. That's why you can see that right after testing the key level and having the turtle soup below this low, price expanded straight away, right? And if you had taken an entry there, it would have worked out perfectly for you because time and price both aligned with each other. And the purge in the turtle soup and the testing of the key level was confirmed by the fact that it happened at a key time and our drawn liquidity was higher. So everything aligned with each other. That's why price expanded higher. Price tested the key level at a key time. That's why it was a high probability, and price took off after took right after it, right? The same way the turtle soup also happened at a key time, right? And you can see all of these things aligned with each other perfectly and made price expand higher straight away. This is the first type of reaction to a key level which happens at a key time. Now let's look at the second type of reaction and let's see what we've got there. In the second type of reaction, we've got a gray area, right? And basically this gray area represents the opposite of a key time, right? Meaning a time where price usually just consolidates or forms a ranging profile, and isn't a high probability time for CRT formation, CRT purges, turtle soup, or for testing key levels, right? For example, an example of such time would be the Asian session or a CBDR time for Euro USD, right? We know that the Asian session isn't a key time for the major forex pairs like euro dollar, pound dollar, or USD cards, and at those times of the day, price usually ranges. So, which means that isn't a key time, right? For example, let's say we are looking at it, we are looking at the 15-minute chart here. So this gray area represents the Asian session, right, which isn't a key time, right? And then the green area represents London Opal Kill Zone, which is a key time of the day, right? Now we know that for Euro USD, Asian session isn't a key time, right? And at that time, price usually consolidate and doesn't form anything significant, right? Right here, you can see that price came down below and tested the key level and had a turtle soup inside this gray area or this gray time. And because of that, you can see that price did not expand it right away, but instead it just ranged there and eventually came down below to purge the low it formed earlier and would have stopped you out. The reason it happened is because time wasn't right and the reaction did not occur at a key time, right? Everything else was the same as the previous one that we discussed, but the only difference was that the other one happened at a key time, that's why it expanded. But this one did not happen at a key time, which is why the concepts like turtle supers or the testing of a key wasn't confirmed, right? Because of time. If it had If it had occurred at a key time, like it did in the graphic on the right, then it would have been a favorable reaction, right? After that, you can see after the Asian session ended, price came down below to took out the Asian session range low and tested the key level again and had a turtle soup. But this time, that turtle soup occurred at a key time, which is the London Opal Kinsole, and that's why you can see that price expanded straight away after that, right? Because time was aligned. Now, in both of these reactions, you can see that both have a similar journey towards the key level, and then both reactions also had similar testing of the key level and turtle soup, but both of them reacted differently, right? Now if you were not familiar with time, then you'd be confused as to why that happened, right? You'd be saying that both of them tested it the same way, but why did one of them reacted explosively and why did the other reacted in a different way, and what were the reasons behind it, right? That is one of the confusions that most of you have, like price reacting to key levels differently and you don't know the reason, and now you do, right? But now that you know time and you know about the time aspect of the charts, you can see that with the first reaction right here, right, price tested the key level and had a turtle swoop below the low at a key time, which confirmed the validity of those things. Testing a key level is one aspect and having a turtle swoop is another aspect, right? And you can see both of the reaction had both of those aspects and both of those things, but only one worked out perfectly, because in the reaction on the right, time was aligned correctly and these things happen at a key time, which which means that time validated these two things, the testing of a kilo and having a turtle soup, right? Now from this example you can realize that turtle soup on its own isn't enough, right? But instead it has to occur at a key favorable time before you could trade it or before you could use it to generate trading ideas or to build narratives. Similarly, you can also see that testing a key level is good, but only if it happens at a key time, right? So remember these things. This is the main premise of this chapter, ensuring that you realize and understand that the concept work best when time is integrated and these reactions happen at a key time of the year, key time of the week, or key times of the day. So, hope you understood both the examples and the different types of reactions, right? In the graphic on the right, you would have what you would have done is that you would have waited for a key time such as the London Open zone before forming any trading ideas or taking a trade, even though you tested a key level, right? That's the importance of a key level. That's the importance of time. Key levels and turtle soup all on their own are good, but they are best when combined with time, right? Now let's move on to the next example. Right here again, we'll discuss two types of reactions to key levels and two types of SMT divergences, right? Now, I hope you understand the framework already, but if you don't, let me explain it to you. The green area represents a key time, and again, it could be any key time depending upon the time frame that you are looking at. If it's a 15-minute time frame, then this would be a kill zone. If you're looking at a 4-hour time frame, then it would be a key time of the week or a key day of the week. If you're looking at it on the 1-minute time frame, then it would be either a silver bullet or a key macro like 3 a.m., 8 a.m., 9 a.m., 11 a.m., and so on, right? And the gray area represents the opposite of a key time, or basically a low probability time, right? Or an unfavorable time. Simply time which we would want to avoid. So in the second graphic right here on the right, you can see that we came down below and tested the key level at a key time, right? And then we also had an SMT divergence formed at a key time with its correlated asset, right? Now the correlated asset might have taken out this low it formed, but this one right here struggled to take out the low, which means we had an SMT divergence. And this particular divergence occurred or formed at a key time. That's why you can see price expanded straight away and expanded higher. On the other hand, you can see that price tested the key level and also formed an SMT divergence there with its correlated asset or pair or whatever. Uh, but both of these things happen at an unfavorable time or at a time which wasn't a key time, right? That's why you can see that they did not work out and went lower to stop you out. Now you can see that testing a key level is great and forming as an SMT divergence is also a good thing, but both of them has to occur at a key time and only then you will see its function and its charm, right? In both these examples here, you can see that it was actually time that confirmed the validity of price. So based on it, you can see that time is important. than price, right? I proved it to you right here. Everyone talks about it, but no one explained it in such a way like I did in this video, right? And it's not the end. Like, we still have yet to discover a lot in the later levels of CPI. In the rest of CPI, we'll discuss things like this sort, and at the end of level 7, you'll have nothing to worry about, and you'll be fully equipped with enough knowledge about time and price and how to integrate them with each other. Here's another graphic that shows the importance of time. You can see that the CRT on the right, the CRT was purged at a key time, and after that, price went out to take out the opposing range high, and it worked out, right? But in the graphic on the left, you can see that the CRT was not purged at a key time, right? That's why it only went and reached the 50%, but then it reversed and took out the low. It worked out in the sense that it reached the 50%, but still for it to work the best, it has to purge. It has to be purged and formed at a key time. And only then you'll be able to see how good it works when it's in the direction of the high time frame drawn liquidity, right? And you'll be able to catch the same executions in perfect traders like me. That's the power of time, right? Price concept in itself are really good and important, but time is what validates and confirms their validity, right? So remember that at all times. Now let's talk about the most important part of this chapter, which is how to use each and every one of these concepts and at which time frames are they best used. So right here you can see that we've got these 3 bullet points, right? So starting from the first one, you can see time of the year, right? To find favorable time of the years and to filter out lower probability conditions and times on the yearly range, you can use concepts like quarterly theory. No, not actually quarterly theory. Don't ever use quarterly theory. I'm talking about quarterly shifts, right? So concept like quarterly shifts and seasonal tendencies, right? They are both used to find high probability and key times on the yearly range and yearly basis, right? Meaning these concepts can be used on the higher time frames like the monthly, the 3-month time frame, or the weekly time frame, right? Next up we've got is the time of the month. If you want to find high probability in key times within a month, right, meaning you want to find high probability weeks, then for that you can use concepts like the open high low close concept, right, which will help you divide the monthly candle or the monthly range into quarters. And you can also use AMD, which will help you profile the markets, or you can use the power of 3 to build a narrative. For dividing the daily range, we've got concepts like kill zones, key times, and open high low concept, right? And open high low close concept, right? These concepts will be used to divide the daily range into quarters, and then you can filter out the lower probability ones, right? I've made chapter on all of these concepts, so make sure to watch them first. Moving on, another important aspect of time is that time can be used for confirmation and the validity of concepts, right? I talked about it earlier, but let me explain it in detail here. So just like I said, time is a great tool for confirming concepts, ideas, narratives, or models, right? We know about all of these concepts, right? And these concepts can be confirmed and validated by using the correct times and aligning it with the correct key time. For example, key levels are formed at a key time. So based on this, we know that there are multiple key levels, right? And now you might be confused as to which one to actually choose and which one to select. And for that, you can use time. You only select those key levels that are formed at key times, right? Use the time concepts depending upon the time frame or the range that you are looking at. For example, if you are looking at the yearly range or the monthly chart, then you can use quarterly shifts and seasonal tendencies as filters. Or if you are looking at the daily range, then you can use kill zones and other key times and only select the key levels that are formed at these within these kill zones, right? Similarly, key levels are tested at key times, right? Just like they're formed at key times, they're also tested at key times. I showed you the example earlier about how this work and why does it matter. And just like key levels, CRT formation and both purges occur at key times as well, right? Now we know that CRT are formed on every time frame and all times, right? Now to choose the only correct ones, you have to use time to filter out the lower probability CRT, and you'll end up with the high quality ones only. Now the most important, which is that CSD or order block entries are formed at key times, right? Now we know that CSD or change in the state of delivery are uh, basically like when price engulfs the candle that purged the CRT or purged the range or had a third soup, right? That's what we call a CSD, when the candle gets engulfed, right? And an order block is formed there. That's what we call a change in the state of delivery, or CSD. And the entry that forms after it is called an order block entry, right? That generates after an order block is formed, right? And the best CSD and the best order blocks entry are formed at key times, right? Which means that when looking for entries, you have to look for key times for that to happen. And if you reverse engineer my trades, you will see that most of my entries are taken at key times, and that is because I'm waiting for price to test a key level at a key time. I'm looking for the purge to happen at a key time. I'm looking for an SMT divergence as a confluence to form at a key time. And then last but not least, I'm waiting for the CSD to happen at a key time, right? And once all of those are perfectly aligned, that's where I take an entry. And you can see that's why I have such a higher win rate, because I wait for only the higher probability trades and only take them when everything is perfectly aligned. Now from this, if you're a smart student, then you'd realize that this is exactly how you can use time to sit out lower probability condition and use it as a filter and only take parts in perfect moves. That's why I have been 80% win rate and I have perfect entries all the time, right? I make sure to wait for the best time when everything's perfectly aligned, and I make sure to sit out the other low probability unfavorable market conditions in times. And last but not least, SMT divergences also happen and forms at key times. Right here in this graphic, you can see that we've got this high, and what happened is the price came above and took it out with this 5 a.m. candle. And with that, you can also see that it took out this high at a key time, which is the 5 a.m. time, right? It's a key time during the day. And that also means that we tested a key level at a key time, because after all, we know that highs and lows are key levels too. With that, you can see that this candle can now be treated as a CRT, right? And because it tested a key level, it also formed at a 5 km key times, right? And then after it, it was it was also sorry, it was also purged at a key time, which is the 9 a.m. time, and all of that led to price expanding lower to take out the opposing range low of the CRT, right? This is exactly how you gauge high probability CRT at key times, right? That's how you build a sharp narrative around it. We've got another example right here. You can see that we formed this low first, and then price came down below to purge that low with this particular candle, right? Now when this candle gets engulfed, that would result in a CSD, or in a change in the state of delivery, and an order block entry would be formed there, right? Once price engulfed that candle as a CSD, right, you can see that price came down below, it tested the order block, and then price expanded higher. But the most important part of this CSD right here is that it occurred at a key time, which in this case is the Tuesday, which is Tuesday, right? So you can see Monday formed a range, and then that range was purged on Tuesday, which is a key time for purges, and price formed the low of the week there, right? So we had a low of the week weekly profile there, and then we had a CSD also on Tuesday at a key day of the week, and after that we expanded higher the rest of the week. That's why this CSD worked out perfectly, because it happened at a key time, right? If it had happened at a different time, then it wouldn't have worked out, even if we had the same price action, right? Because we know that time is more important than price. Moving on to the next slide, right here we'll discuss key times for different time ranges, like the yearly range, the monthly range, weekly range, and the daily range, right? And then at the end we'll discuss kill zone for your daily range and some key times that you can note down. First one we got right here is the yearly range, right? And how to use time in it. So just like I told you earlier, for a yearly range, you're going to use concepts like seasonal tendencies and quarterly shifts. Key times of the year for significant moves and expansions are determined by analyzing and using seasonal tendencies, and then aligning them with quarterly shifts and checking for major SMT divergences, right? I've made a separate chapter on this process, so you should watch that for getting a better understanding of it. And with this approach, you'll be able to identify the best month inside the yearly range for expansions and significant moves. Next up we've got is the monthly range, and we'll learn about how to use time to filter it out, right? For it, you can use concepts like the open high low close concept, AMD, and power of 3. Now remember, these aren't the only concept you'll use, right? You'll make sure to combine the other price concept and the other time concepts with each other in a logical manner, right? You're going to use key levels, CRT, dealing ranges, and everything, right? You will make sure that you match it with the higher time frame analysis from the monthly and the yearly range in charts, right? We can use the open high low close concept to divide the whole monthly candle to quarters, and it'll tell us about the best times of the month according to key levels for expansions and other significant moves, right? It will also acts as a filter to stay out of the markets at ranging conditions. The basic premise and idea is that week 1 is usually consolidation or ranging profile, and then week 2 is a manipulation which purges liquidity, and week 3 is then a distribution where the best moves occur, and then week 4 can be either a continuation or a reversal based on key levels and based on whether the drawn liquidity has been reached or met or not. Right? These aren't the only combination, but this is just the basic premise and idea on how to build a narrative, right? You should also be able to make various one of them accurately and generate trading ideas with it, right? Moving on, in this slide, we're going to discuss how to use time inside weekly ranges, right? We'll use concepts like open high low close concept, AMD, and weekly profiles, right? Weekly profile is the most important one for building narrative, right? It takes time into consideration and making or generating ideas. It basically follows the same principle as the monthly framework. You just need to integrate them appropriately with the higher time frame analysis, right, and use them logically with each other, right? And you'll then be able to find key times within the weekly range for significant market moves. Now, in this last slide, we'll discuss the kill zone for both forex and indices, and we'll discuss the characteristics of each kill zone, and along with that, we'll also discuss some key times, right? So for forex, the times of the kill zones are the following. Asian session is from 20 Eastern Standard Time to midnight or 0 Eastern Standard Time, right? That particular time of the day is what we refer to as the Asian session, and we all know that Asian session usually forms a ranging profile and isn't a key time, right? We should avoid trading at that time of the day if you're trading a major forex pairs like EUG or USD CAD. Then we've got the London Open zone, which is from 2 Eastern Time to 5 a.m. Eastern Standard Time, right? And that is a key time for manipulation profile to occur or expansions to form. London Open is where usually the high of the day or the low of the day is formed. So you can look for a price to test a key level and turtle soup to occur at this time of the day, and then time will confirm their validity and their quality. You can also look for CRT purges to happen at this time of the day. Then we've got the London lunch, which is from 5 Eastern Time to 7 Eastern Time, and usually it can be a reversal profile. It can be a reversal profile if London Open reaches the drawn liquidity. And in that case, usually at the 6 a.m. candle time, price purges the 1 a.m. CRT, 4-hour CRT, and reverse from there. Otherwise, it's a continuation of the London expansion. Then we've got New York Open, which is from 7 a.m. to 10 a.m. Eastern Time, and this is also key time for expansions, testings of key level, purges, or turtle soup to occur, right? But you have to make sure that everything is aligned with each other before making a decision, and that way it will always be an informed decision and not a random and uninformed one. New York Open can be a good time for reversal profile and CRT to be purged at the 9 a.m. candle, and for price to reverse if the drawn liquidity is reached, right? And otherwise, it can be a continuation of the London move. New York Open is also where the OTA is formed and price retraces a bit before expanding. Then we've got the London Open zone where the daily range is capped, and it's a perfect time for the CRT to be purged and for price to reverse. Each one of these kill zones have different characteristics, but it all depends upon the framework that you're working with, right? It can be a continuation, a reversal, a retracement, whatever, but you have to make sure you're using the right framework and the correct high time frame analysis and drawn liquidity, and then the narrative that you have built is also accurate and sharp. On the left, you can see some key times within the kill zone where you can look for purges, turtle soup, SMT divergences, or key levels to be tested, right? If you reverse engineer my trades, then you'd notice that most of my entries are taken within these key times, within these kill zones, right? And in the bottom, we've got the kill zone for indices. You can see the rest of the timings characteristics are the same. The only difference is that with indices, we've got a New York AM kill zone and then the New York PM kill zone, right? And you can see the timing for that too. All of these are the different times that you have to match with price in order to make informed decisions, right? All of these must be accurately integrated with the rest of the concepts, and then that's how you will see how good it works. Now, this chapter alone is more than enough to equip you with the right knowledge, but I'll make sure to explain it as much as I can in CPI in other chapters, so you are independent at the end of CPI, right? That was the time chapter.